If left unchecked, inflation will stop you from retiring. And in this video, we're going to talk about why that is. There will be 4 sections to this video. In section 1, we'll recap on inflation, and we'll talk about why it's reasonable to expect an annual average inflation rate of about 2%. In section 2, we'll talk about the relationship between inflation and your money. In section 3, we'll talk about some important points to consider when planning for retirement. And in section 4, we'll talk about how interest rates impact inflation and what rising interest rates mean for us as individuals. Collectively, these sections will illustrate why inflation is a problem for your future retirement. Make sure you stick around to the end of the video because I'll be sharing my top tips for protecting your retirement against inflation. Inflation is defined as a general increase in the prices of goods and services in the economy. Over time, the day-to-day items which we buy tend to become more expensive. For example, between January 2000 and August 2022, the prices of goods and services in Ireland increased by 56.9%, according to the Central Statistics Office. Over the same period in the States, prices increased by about 75.5%. So the rate at which prices increase depends on where in the world you live. Looking at the chart from Ireland, we can see that between January 2000 and September 2008, there was a very clear upwards trend in prices. Then, with the onset of the Great Recession, there was a period of deflation where prices were falling between October 2008 and January 2010. The period between 2010 and 2012 saw a brief return to rising prices, before prices effectively flatlined for the next 8 years until 2020. Now we're once again living through a period where the prices of goods and services are consistently rising by a significant percentage. The point here is that inflation isn't consistent on a year-to-year basis. Prices might increase significantly for the next 3 years, before decreasing for 2 years and then flatlining for 5 years. We just don't know what's going to happen. However, what we do know is that over long periods of time, prices tend to increase. Central banks like the European Central Bank for the Eurozone, the Bank of England for the UK, and the Federal Reserve for the States are responsible for maintaining what's known as price stability in their respective economies. Essentially, it's the responsibility of central banks to make sure that inflation is under control. Most central banks have a target rate of 2% for average yearly inflation, meaning when inflation in any given year or years is far above 2%, like it is now, central banks will introduce policy changes to try and get inflation back down to around 2%. We'll talk more about those policy changes later in the video. But why 2% and not 0%? Why do central banks want prices to increase? The reason why the target is set at 2% is to avoid deflation. According to the Bank of England, we don't want inflation too close to zero because people may put off buying things if they think prices will go down. If many people did that, it could lead to deflation, which isn't good for the economy. So having a target of 2% means we are more likely to avoid deflation than if our target was 1% or even 0%. So it's reasonable for us as individuals to assume that over the long term, inflation will average out at around 2% because the powers that be will be striving to achieve that. Meaning, at a minimum, we must factor an annual inflation rate of 2% into our retirement planning. To understand why, let's move on to section 2 of the video, the relationship between inflation and your money. Earlier we mentioned that the prices of goods and services in Ireland increased by 56.9% in the 22 years between 2000 and 2022. Let's assume that over the next 22 years, between now and 2044, prices will increase by another 56.9%. What would that mean for you and your money? Take a look at whatever amount of money is currently sitting in your bank account. In order to be able to buy the same amount of things that you could buy with all of that money today, but in 2044, your money will need to grow in value between now and then by a minimum of 56.9%. That means a bank balance today of €10,000 would need to grow in value to €15,690 by 2044 just to be able to buy the same amount of things that we can buy today. In other words, if the money in your possession today is not growing in value at a rate that at least equals the rate of inflation, then you're losing money. Even though the amount of money physically in your bank account might not have changed, what you can actually buy with that money has changed. I can't emphasize enough how important it is to understand that concept. This is what presents the greatest risk to your future retirement, especially for those of you who keep all of your money in the bank and don't participate in any investing. Here's why. These are the kind of returns offered by bank savings accounts in Ireland, and in most countries around the world, it's the same story. Bank accounts accounts don't offer enough growth for our money to keep up with inflation. Remember, 2% is the reasonable expectation for annual inflation, so we need to be growing our money by at least 2% every year. These accounts offer 0.25% at most, meaning if we keep all of our money in these bank accounts, we're going to be less well off in the future than we are today. Not good news for our retirement. Conversely, the likes of the US stock market, as represented by the S&P 500 index, has offered investors on average between 9 and 10% in growth per year for the last 50 years. Decades of data has shown that in order to protect the value of your money over time, you need to stray beyond the safety of a bank account. And the reason why I say safety is because if we're more or less guaranteed to lose money by using them over the long term, can they really be described as being safe? Especially when compared to what we could be doing with our money, which we'll talk more about at the end of the video. Now that we understand the relationship between inflation and our money, let's move on to section 3 of the video, important points to consider when planning for retirement. There's a common misconception that you'll be able to solely rely on the government to support you in retirement. While it is true that by virtue of paying your taxes, you are entitled to receive state support in retirement, that doesn't mean that the state support you receive will be sufficient to support your lifestyle. For example, in Ireland, the state pension is just over €13,000 per year, but the average salary in Ireland is €45,000 per year. So an average Irish person relying solely on the state pension in retirement would experience a 71% drop in their annual income. How do you plan on sustaining yourself with 71% less income? To make matters worse, the already insufficient government support isn't even guaranteed to exist in the future. People are living longer and spending more time in retirement. More people in retirement for longer means more taxpayer money is required to pay for it. This is a major problem faced by any country with an aging population. Plus, state pension payments themselves oftentimes aren't increased in line with inflation, meaning even if you were receiving state support in retirement, the value of what you're actually receiving each year will be declining. The same can be said about money you earn throughout your working life. If your salary isn't increasing each year at the same rate as inflation, then you're technically getting a pay cut. If you earn €40,000 today and prices increase by 5% between today and next year, if you don't receive a pay rise of at least 5%, then you've gotten a pay cut. Even though your salary of €40,000 hasn't changed, what that €40,000 can buy has changed. It's the same concept as what we were talking about earlier with money in your bank account. That's why there's been so many strikes from workers around the world demanding higher pay in public sector jobs to counteract the high inflation which we're currently experiencing. But as you'll no doubt be aware, it's not guaranteed that your employer will increase your salary each year in line with inflation. In fact, most policymakers would discourage employers from doing so, given the risk of a wage price spiral and the effect that this can have on inflation. Essentially a never-ending loop where an increase in wages to offset higher prices leads to higher prices. So you can't really rely on either the government or your employer when it comes to securing your retirement. Before we get to my recommendations for what you can do to protect your money against inflation and to secure your retirement, we first need to discuss section 4 of the video, how interest rates impact inflation and what rising interest rates mean for us as individuals. We mentioned earlier that central banks will introduce policy changes to try and control price movements in the economy. Those policy changes typically concern interest rates. But what do interest rates have to do with the prices of goods and services in the economy? To answer that, we need to take our understanding of inflation just one step further. Why is it that prices increase in the first place to cause inflation? Demand. Specifically, demand in excess of supply. Inflation is the byproduct of too many euros, pounds, or dollars chasing too few goods. How does that happen? Well, on the extreme side of the scale, you can have a situation like the global pandemic. The pandemic resulted in households stockpiling record levels of savings, while at the same time, the global supply chain system, which we rely on for sourcing goods, effectively collapsed. This resulted in a mismatch between supply and demand for goods, which subsequently caused an increase in prices. Central banks can only influence the demand side of the equation in order to try and tame inflation. They have no control over shortages in supply, like we're seeing in Europe with the current energy crisis. How central banks influence consumer demand is through interest rates. When central banks increase interest rates, like they're doing now, it becomes more expensive for businesses and individuals to borrow money, which tightens the money supply. By tightening the money supply, the central bank can reduce consumer demand for goods and services, which in turn should lead to lower inflation. Conversely, if central banks wanted to encourage spending, they would lower interest rates and expand the money supply. Given that central banks are currently increasing rates, how does that affect us as individuals, and is this something that we need to factor into our retirement planning? I recently uploaded a video talking about how rising interest rates affect your mortgage repayments, which you should check out after this. But the long and short of it is that anyone with a variable rate loan, be it a mortgage or otherwise, could end up paying more money to the bank because of rising rates, meaning you need to be very cautious taking on debt in a rising interest rate environment. Yes, inflation can be beneficial for borrowers who owed money before the inflation occurred, given that they're repaying the bank with currency that is worth less today than when they borrowed originally. However, given that higher inflation is typically followed by higher interest rates and a higher cost of borrowing, I would still try to avoid debt insofar as possible. Rising interest rates also increase the risk of recession. Given that higher rates reduce the demand for goods and services, that translates into lower output by companies, and by proxy, lower output by economies, which, if severe enough, could trigger a recession. There's always the risk that companies will counteract lower revenues by cutting back on their workforce, therefore leading to higher unemployment. So it's important that you're at least considering the possibility that a consequence of central banks increasing interest rates could be a recession and higher unemployment. How would that affect not only your retirement planning, but also your ability to provide for yourself today? It's also important to be aware of the effect that rising rates have on investments. Higher interest rates typically spell bad news for the stock market, given the relationship between prevailing interest rates and stock valuations. That could mean higher volatility in the short term, and a higher likelihood of missing the mark in terms of achieving a return that at least keeps up with the rate of inflation. Any of you who are engaged in any investing activity should be aware of this. It's also worthwhile noting that rising rates can actually be a good thing for bank savings accounts, and may result in some banks paying depositors more interest. However, the change wouldn't be large enough and wouldn't last for long enough to justify keeping all of your money in the bank. So we know that it's reasonable to expect inflation of 2% each year. We know that inflation reduces the value of our money over time. We know that inflation makes state pension support even more insufficient than it already is. And we know that the higher interest rates which come with inflation have implications for our borrowing costs, investment returns, and even job security. If left unchecked, inflation will stop you from retiring. It hinders your ability to maintain a consistent standard of living throughout retirement, given that over time, your money will be able to buy you less and less. For me, the goal of retirement planning is to ensure that we've enough financial resources at the day of our retirement in order to allow us to maintain our pre-retirement standard of living throughout retirement at a minimum. With that being said, what should you be doing to protect your money against inflation and to secure your retirement? As we've already alluded to, the answer lies in investing and not keeping all of your money in the bank. Here's what you need to do. Number one, maximize the amount of money you're putting into your private pension. If you don't have one, get one. The reason why you want to do this is because you'll get a ton of tax benefits for doing so, and in many cases, your employer will put additional money into your pension on top of your salary. In other words, free money. You also want to make sure that your pension contributions are being invested in something that makes sense relative to your age. Number two, if after maximizing your pension contributions, you still have excess money each month that would otherwise just sit in your bank account, start investing in low-cost index funds. For example, an S&P 500 ETF. That way, you're investing in a highly diversified investment product which has historically outperformed the vast majority of investment strategies. Plus, it requires virtually no time investment on your part aside from choosing the right fund for you. By doing those two things, you'll give your money the best possible chance to keep up with and even beat inflation, so that when you retire, you'll have sufficient resources to maintain or even exceed your pre-retirement standard of living. Beyond that, throughout your working life, you want to avoid lifestyle creep. When you start earning more money, don't automatically convert that increase in salary to more expenses. Instead, allocate the majority of your salary increase to your investments. The goal here is to earn as much as possible, invest as much as possible, and spend as little as possible. The caveat is that you shouldn't totally sacrifice your standard of living today for the benefit of your future self. Absolutely spend money on what you want, but just be conscious that it's all about striking a healthy balance. Remember what we said earlier about avoiding debt. If you're paying hundreds, if not thousands of euros, pounds, or dollars to the bank in interest, how are you going to have any money left over to invest in your pension. The same thing applies to excessive spending. Now that you're in the know about the importance of protecting your money from inflation, you're going to need more guidance on what to invest in. Check out this next video to see what 3 index funds I'm currently investing in to secure my retirement. I'll see you soon.